Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include just how can we end the government shutdown? My interview with DaylightAML's Rob Simpson on the growing debate around making agency loans assumable. And it's Fed decision day. Optimal Blue is the only end-to-end capital markets platform built to power performance, precision, and profitability. Their cloud-native API, First Technology, connects the primary and secondary mortgage markets, helping lenders of all sizes operate more efficiently, manage risk more effectively, and maximize results. Optimal Blue. Modern technology, proven results. Is anyone motivated to end the government shutdown? I mean, really motivated. One side sticking to their guns about healthcare, the other side is fine with slowing down the economy to move rates lower. And now we have the expiration of SNAP benefits. The impact on the overall economy seems to be minimal, although we, including the Fed, aren't receiving the usual stream of government economic data. Although we are seeing the labor market slow and the economy will follow. We do know that the average rate on a 30-year mortgage fell to 6.19% last week, the best rate borrowers have seen in 3 years outside brief dips in 2024. Meanwhile, lenders who have an eye on the future are constantly watching the cost per loan. What are you trying to do to improve your pull-through? After all, higher pull-through automatically lowers your cost per funded loan. Lenders continue to want to offer all products to any borrower that walks through the door or calls. So, non-agency, home equity, and adjustable rate mortgages are all the rage. We learned yesterday that U.S. consumer confidence declined for the third straight month in October, hitting its lowest level since April, as Americans grew more pessimistic about the economy's direction amid slowing job growth and lingering inflation. The Conference Board's expectations index dropped to the weakest level since June, reflecting rising anxiety over employment prospects and income stability, even as current conditions held up modestly. Ongoing concerns about inflation, which remains elevated at 3%, well above the Fed's target, and uncertainty stemming from trade tensions and policy instability have further dampened sentiment. Overall, consumers appear increasingly wary about the near-term outlook, with many fearing a recession may already be underway. For today's interview, I wanted to welcome back to the show DaylightAML's Rob Simpson to talk about the growing debate around making agency loans assumable, examining whether such a move could unlock housing market liquidity or create new pricing and equity challenges, how it might impact lenders, investors, and borrowers, and what lessons policymakers can draw from past market interventions. He's a seasoned expert in BSA/AML compliance and investigations, and just an overall expert in fraud and anti-money laundering, as he's been investigating it for more than 3 decades.
I get a lot of flack with these podcasts of, hey, you talk to somebody that's an expert in their field and you kind of go above what the average listener understands. We're going to start with Assumable Mortgages 101, and then we'll get into some deeper stuff. Can you explain what an assumable mortgage is? Then kind of beyond that, what we're talking about here in terms of expanding it to Fannie Mae and Freddie Mac loans, where we are in that process or why it's being considered or just how far along we are there?
Sure. For those who are not expert in assumable loans, what that means is if a lender makes a loan secured by a piece of property, that the next buyer to come along and say, I want to buy that house, if it has an assumable loan, they can approach the bank and say, hey, you currently have a loan on 9322 Gordon Avenue. Can I take over payments on that loan? And they go, are you qualified? And you say, yeah, here's all my information. I'm qualified. And the bank waves its magic wand and the first owner of the house is forgiven. They're taken off the loan, and I get to step into their shoes and take over their loan. I assume their loan, and I get to own that house with the loan that is currently still on that house. That's how assumable loans have worked. And VA loans and FHA loans have a long history of allowing their loans to be assumed by the next buyer that comes along.
If this proceeds, if assumable loans become more mainstream, is that going to thaw liquidity or is it going to create a new layer of complexity in pricing and underwriting?
Well, if you're talking about the GSEs and the loans that they make, sure, there's administration that comes, some administrative hassle that comes with making loans assumable. Let's just use a solid example. There's a $500,000 loan on the house on Gordon Avenue. There's a loan. If if that loan is assumable, if by the terms of the loan it is assumable, that means buyer B that comes along next year can take over those payments. Well, that's not been the case with Fannie and Freddie in the past. GSE loans have not had the same feature that FHA and VA loans have had. So what we're talking about is, well, do we want the GSEs to offer assumable loans? You'll get differing opinions on that, but it is a utility, a feature of loans that the GSEs to this point have not really offered to the public.
Some people argue that assumable loans could distort fairness between homeowners with existing low rate mortgages and those without. When it comes to the policy surrounding this, and I'm sure this is a great time to talk policy with I was going to say SHIT show in DC going on right now, but how could policymakers kind of balance innovation with equity in a system where this is more prevalent?
Well, let's talk about the differing equities. Let's talk about the competing interests that you have. I think that's where we have to start. So you have buyers that want to buy real estate, and if they see a property they like, and there is a 3% mortgage there that they could assume, they could step into, man, that has value to the buyer. Wow, really? You mean I can get a 3% loan on this house? Yeah, just assume the loan that is currently in place. Who does that help? That certainly helps a seller who wants to market their property. A seller with a big 3% mortgage on it is going to have an advantage over a seller who owns his property outright because there's no enticement with that property that's owned outright. That buyer would have to get the current 6% rate or whatever it is. So it upsets those equities. It affects the sellers of real estate. And I think of the institutional investors we all know who have snapped up millions of residential properties in the United States. If suddenly they can't sell their properties as effectively as those who might be encumbered, the investors own those houses outright. If their house values are deteriorating because there's no 3% loan that can be assumed, yeah, I would expect them to scream bloody murder.
Yeah, I'm sure they would. And let's assume that FHFA did make all GSE loans assumable. And that might be a stretch for me to do that, but we love hypotheticals on this podcast. What would the ripple effects be on originators, MBS investors, secondary market pricing? I mean, who ultimately is bearing this risk?
All right, let's think through this step by step. If this administration, which has been very comfortable breaking norms, decides with the stroke of a pen, we are going to decree that all GSE loans currently on our books are assumable. I'm not sure the legalities of that, but I think I'm not sure the legalities of that apply to about 25 things that I've seen in the last 6 months. I'm not sure that they've got the legal authority to just decree that they're all assumable, but if they did, what that means is that there is literally trillions of dollars of sub 5% loans out there that would be available to be assumed by potential purchasers in the market. And I think the effect of this is probably best illustrated with some numbers. And I know that numbers in a podcast are just a terrible thing to introduce. There's no quicker way to lose an audience than to start throwing numbers. There's no chalkboard here for us to write on, but start with this. A $500,000 loan at 3% is within nickels of $2,100. So use $2,100 as the baseline, $500,000 loan. That was your world in 2021. That was how people bought and sold property in 2021. $2,100. Well, today that same property is worth 750. So it is stalled. It's not going anywhere because the current rate is 6% or more, and the price is 750. So here's a figure for you. The current house price, monthly payment for that house is $4,500. It's within nickels of $4,500, and it was $2,100 just 4 years ago. That's a staggering difference. That's up $2,400 virtually in just 4 years, and there's no shaving of rates down to 5.75 or 5.5 that's going to affect that at all. It's just the math doesn't work at a $750,000 purchase price for that same home. That's the world we're in.
Do you think that bold administrative action, and I mentioned it with kind of making all these GSE loans assumable, it's sound market innovation or it's dangerous overreach? It's creating a larger problem than it seeks to solve. Policymakers here, hopefully they can glean some lessons from things like their COVID era forbearance programs, right?
Well, Robbie, I think that's a good example of I'm overreach sounds like I'm judging it. It was certainly a response to a global pandemic where we said you can forego payments. We're not gonna ding you for ceasing making payments for a period of time. Well, that had ramifications. That had ramifications because lenders who are prudent and trying to do their job run metrics on their defaults. What loans went bad? Who's not paying? Well, all of a sudden, for a period of years, those internal metrics that lenders were trying to judge meant nothing. You couldn't take any conclusions from your default data and say, oh, we must have been making bad loans. Hell no. You might have a bunch of loans that aren't paying just because people wanted a year off. And that was true in many cases. So when you fiddle with the market, there are ripples in the pond that go out and affect everybody. As I say, leave you bobbing in the wake. So yes, it has ramifications. We have ramifications because of Fed policy that took rates down to, under 3%. It will have ramifications, but what we're trying to do is find a way through the problem, the malaise that is affecting all of us now with, in my example, a $500,000 house is now $750,000, and that payment bumped up from $2,100 to $4,500. That's not doable. You know the movie The Big Short?
Of course.
Steve Carell. All right.
Of course. All of my friends say, is that what you do whenever they
Okay.
I'm mortgage banking?
So Christian Bale's character, Michael Burry, he gets in and he looks at the numbers. He actually pulls out the securitizations and he starts examining the loans that are in these securities. And the movie makes a big deal about, well, no one else was doing this. No one was looking at the numbers. And one of the characters goes, well, not even the lawyers are looking. Nobody's looking at what comprises these securities. And what Burry realized was the answer is in the math. And so he creates credit default swaps and makes $1 billion because he looked at the math. What I hear is people talking about how our world is going to be better by 5% rates. Well, our 5% rates just don't do anything for us if our price is still $750,000 for that $500,000 house. A 5% rate gives a payment of $4,026 at 5%. So unless we have a big adjustment in prices, your house that was $2,100 4 years ago with a big reduction in rates down to 5% is $4,026. That is just not that's as impossible for most borrowers to get there as it would be for me to buy next to David Geffen out in Malibu. I can't do that. The math doesn't work, right? I can't move in next to Spielberg. The math doesn't work. And if there isn't a correction in values, sorry, no one wants correction in values. But if there isn't a correction in values, the 5% $750,000 loan is just not achievable for the borrowers we want it to be achievable for. So I hear all this analysis about, oh, the world's just going to take off when rates go to 5%. Your refis may do well. For more mortgage lenders, it may be terrific to get to 5%, but it's going to do damn near nothing to get the public into housing at 5% without a reduction in values. It's just the Michael Burry math. And so do we help the world if this administration just says, hey, we're going to make all the GSE loans assumable? Well, all of a sudden you've put all those 3% loans into the stream of commerce again. All of a sudden it matters when you go to buy a house. Does that guy have a 3% loan on there? I can assume it sure makes that house more appealing than if it's owned by BlackRock and it's owned outright and they have nothing to give me. And I got to get the market rate at 6 or 5.5. It makes a big difference when you're leveraging the purchase.
That's a very, very good point. And shame on me for moving from the whimsical at the beginning to the more practical at the end. But how close are we to any action happening here? I'll ask you to speculate a little bit when it comes to that.
I think there's a feeling of boldness that is out there. I would not even entertain this idea 5 years ago of making, with the stroke of a pen, all of the GSE loans assumable. Wouldn't have even thought of it. I mean, my world, I teach anti-money laundering. I teach anti-fraud. My space is the fraudulent aspect of mortgage lending. That's my world. And I look at the issues facing us as an industry, and I think people are in the mood for bold, but that means consumers are in the mood for bold too. And I think what's going to come back in the next 6 months to a year is this idea of purchasing properties with a wrap, or I'm seeing on YouTube now videos about buying properties subject to. Robbie, are you familiar with that concept?
I am. My head over here is just going to, is there going to be a class action lawsuit when it's, hey, my neighbor's house sold for way more than mine because they had a lower mortgage rate, and that's not fair. But you can go on with the.
Yeah, you bet. A lot of people, when you play with market forces, can get unhappy, and it can affect people's rights, and lawsuits get brought. Let me articulate a little bit about this idea of buying with a wrap or subject to. If you have a property that's worth $1 million and there's a $600,000 low interest rate first, what had been done in years past is to pay $1 million for that house, but do it on a contract where you are buying subject to or wrapping that $600,000 first into the contract. So, Robbie, I buy your house for $1 million and I sign a contract with you, and I say, oh, that 3% loan that you have, trust me, I'm going to make the payments on that. I'm going to take that over. Now, that's just an agreement between you and me. I haven't talked to your lender. Your lender doesn't know I exist, but I'm going to take the property off your hands on a contract, and I'll pay you the difference between the $600,000 and your $1 million purchase price. I can finance that or pay it in cash. And then I'm going to take over your 3% loan. Well, that's not exactly cricket, because you have a clause in your contract that you're not going to transfer title to the property without the lender's permission, right? Alienation of title. But we're just going to hope that the lender doesn't know or care that I've taken over your payments and I'm paying you on the house. This was really common. It's been common in the past, 80s and 90s. It was referred to as purchasing a property with a wrap. Again, the most recent YouTubes are on buying subject to. I don't know that it's defrauding anybody. I don't know that you can bring a fraud charge here. I think you can allege that you maybe have breached your contract, but I have no privity of contract with your lender. I don't care about them. I don't care about your obligations to your lender. I'm contracting with you. I'm going to buy your house and I'm going to take over that 3%. You are kind of taking the risk, and kind of me too, as the purchaser, that your lender would get mad at you for transferring property, and they would call the loan. That's what we're risking here by buying a property that way. So does it bump up against fraud? I don't think it gets that far. I think it gets into contractual obligations, but I think this is going to be a consumer reaction to these 3% rates that currently exist. I can't get them because they're not assumable. And I'm going to expect that from consumers, they're going to go, well, the heck with you guys. I'll just take that 3% rate anyway, and I'll contract with Robbie and buy his house and take over that 3%. That I think is coming. I think that's coming in spades, actually, because it's the consumer taking over and saying, I don't care what your lender rules are. I want that 3% loan. Do we obviate all that and just come straight to a solution where Pulte just declares all his loans are assumable? Maybe we go that way. Right now, our plan in this country is, hey, buyer, go buy a house and get a 6%, 5.75% rate. Go buy the house. And the consumers are saying, well, number one, I can't qualify at that rate. And number two, no, I want the 3% rate. So these are the market forces that I think are competing on a really potentially contentious issue, but it certainly isn't one that is beyond the pale.
For the sake of today's call, kind of anything else that you think people should be aware of when it comes to this, or any kind of closing remarks, things maybe we didn't touch on that you think are germane to the conversation to round it out?
I think the final point I would make is that when there are interferences with market forces, and that could be interest rate manipulation or it could be mortgage fraud, when there are market forces at work, expect to see moves. I think it's unreasonable not to expect moves. So I think from consumers, you're going to find this buying subject to is going to be an issue. I think you're going to get pushback from the major players, lenders, institutional owners, if Pulte tries to make loans assumable that currently aren't. But I certainly feel like this market is accepting of bold moves. And so I'm expecting some bold moves in the next, by year end.
Bob, it was a pleasure seeing you in Vegas last week. Always a pleasure.
Robbie, great to see you.
Yeah, great to see you too. And hopefully we'll have you back on soon to discuss more of this.
All right, man. Thanks very much.
While the financial press is focused on the government shutdowns cutting off SNAP benefits, elsewhere it's the Fed, the Fed, the Fed. Well, a 25 basis points rate cut is a foregone outcome at the conclusion of the Federal Open Market Committee's 2-day meeting later today. The statement is expected to signal a dovish cut, keeping the door open for another rate reduction in December amid ongoing economic uncertainty. Chair Powell may attempt to moderate that dovish tone in his press conference, and some officials, including Governor Waller, have urged caution in cutting, citing mixed economic signals and complications from the government shutdown that have delayed key data. Your takeaway? Although the lack of fresh information engenders reason for a more measured approach, the broader economic trajectory suggests the Fed is unlikely to halt its easing cycle at this point. Well, the main headline yesterday was that the bond market held up well through an underwhelming $44 billion 7-year note sale that made for a poor conclusion to this week's note offering slate. Today's headline will obviously come from the FOMC decision, with the statement due at 2 p.m. Eastern, followed by Fed Chair Powell's press conference. With a 25 basis point rate cut to a target range of 3.75 to 4.00%, a foregone conclusion, the market will be looking for clues regarding the Fed's thinking on the December meeting. where odds are currently around 86% for another 25 basis point rate cut this week. Today's economic calendar kicked off with mortgage applications increasing 7.1% from 1 week earlier, according to data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending October 24th. Later today brings pending home sales for September, $30 billion of new 2-year FRNs, and the latest decision from the Bank of Canada where a 25 basis points cut in the target rate is also expected. We begin Fed Decision Day with agency MBS prices unchanged from Tuesday's close, the 2-year yielding 3.50 and the 10-year yielding 3.99 after closing yesterday at 3.98%. Let's wrap up with a joke and some housekeeping. I'm hearing out there that pumpkins are better than men. Every year, a woman gets a brand new crop to choose from. No matter what your mood is, the pumpkins are always ready to greet you with a smile. They usually make a better pie than a man does. I mean, they're always on the doorstep waiting for you. If you don't like the way he looks, you can just carve him another face. If he starts smelling up your place, you can throw him out. From the start, you know a pumpkin has an empty, mush-filled head to begin with. And a pumpkin is turned on or lit up only when you want him to be. Thanks again to Optimal Blue for sponsoring this week's podcasts. Optimal Blue is the only end-to-end capital markets platform built to power performance, precision, and profitability, helping lenders of all sizes operate more efficiently, manage risk more effectively, and maximize results. To learn more, visit optimalblue.com.